Ever heard of a company that was the seventh largest in America one day and bankrupt the next? It sounds like something out of a movie, but this is the real, jaw-dropping story of Enron. In the late 90s and early 2000s, Enron was the darling of Wall Street. It was seen as an innovative, forward-thinking energy company that was changing the game. Its stock price was soaring, and its executives were celebrated as geniuses. But behind this shiny facade, a massive deception was taking place, one of the biggest corporate frauds in history. So, what exactly was Enron? It started in 1985 as a pretty straightforward natural gas pipeline company. But under the leadership of CEO Jeffrey Skilling and Chairman Kenneth Lay, it transformed into something much more complex. They didn't just want to sell energy, they wanted to trade it, like stocks and bonds. They created a market for things like electricity, natural gas, futures, and even internet bandwidth. They were pioneers in this new asset-light business model, and for a while, it seemed to be working brilliantly. Investors loved the story. Enron's revenues reportedly grew from about $9 billion in 1995 to over $100 billion in 2000. It was an incredible, almost unbelievable, success story. And as we now know, it was, in fact, unbelievable. The secret to Enron's success was a toxic cocktail of aggressive accounting, corporate greed, and outright lies. The main ingredient was something called mark-to-market accounting. Normally, a company records revenue when it actually receives cash for a product or service. But, with mark-to-market, Enron could book the estimated future profits from a long-term deal the moment the contract was signed. Imagine signing a 20-year deal to supply electricity. Instead of recording the profits year by year as the money came in, Enron would estimate the total profit over the entire 20 years and put it all on their books for that first year. You can probably see the problem here. These profits were just educated guesses, highly subjective and easy to manipulate. If the market changed or their predictions were wrong, those projected profits would never materialize. But it made their quarterly earnings reports look fantastic. It created the illusion of massive, consistent growth, which is exactly what Wall Street wants to see. This pressure to constantly meet or beat earnings expectations created a culture where fudging the numbers was unjust tolerated, it was encouraged. They were essentially booking phantom profits based on a future they were just inventing. But what about the losses? Every business has deals that go bad. Where did Enron hide its failures? This is where the story gets even more complex and sinister. The mastermind behind this part of the scheme was the Chief Financial Officer, Andrew Dowse. He created a web of thousands of off-balance sheet entities, basically shell companies with bizarre names like Raptors and Jedi. These were called Special Purpose Entities, or SP. Technically, these were separate companies, but in reality, they were controlled by Enron executives, including Fasto himself. Here's how it worked. If Enron had a bad asset, like a failing power plant in India or a soured investment that was losing millions, they wouldn't report the loss. Instead, they would sell that failing asset to one of these SPEs. The SPI would buy it using money borrowed from banks, often with a secret guarantee from Enron that the bank wouldn't lose money. So, on paper, Enron had gotten rid of the bad asset and even booked a small profit from the sale. It was an accounting magic trick. They were making their debt and their losses simply disappear from view. This created a vicious cycle. To keep the illusion going, Enron had to grow bigger and bigger, making more and more deals to generate new mark-to-market profits to cover up the old, unrealized ones. and they needed to create more and more space to hide the growing mountain of debt. Fasto and other executives were personally profiting from these SPEs, earning millions in management fees, while simultaneously hiding the company's true financial state from its own investors and employees. They were essentially paying themselves to help the company lie. For years, nobody questioned it. The stock price was high, the analysts were cheering, and the executives were getting rich. They won awards for being the most innovative company. But a few people started to get suspicious. Journalists and analysts who dug deep into their financial reports found them to be almost impossible to understand. How was Enron actually making money? The numbers didn't add up. One Fortune magazine writer, Bethany McLean, famously asked in a 2001 article, "Is Enron overpriced?" That simple question was the beginning of the end. The house of cards began to wobble in early 2001. The tech bubble had burst, and the markets were getting nervous. It became harder for Enron to use its own inflated stock to back up the deals with its shell companies. In August 2001, CEO Jeffrey Skilling abruptly resigned, citing personal reasons. This was a massive red flag. Why would the captain abandon a ship that was supposedly sailing so smoothly? Panic started to set in. Then came the bombshell. In October 2001, Enron announced it had to restate its earnings for the past 4 years. It admitted to a staggering $586 million loss and revealed over $1 billion in hidden debt that was suddenly being brought back onto its balance sheet. The magic trick was over. The curtain had been pulled back and the ugly truth was revealed. The company's claims of steady, predictable profits were a complete fabrication. The market reaction was brutal and swift. Investors, realizing they had been lied to for years, stampeded for the exits. The stock price, which had been over $90 a share just a year earlier, collapsed to less than $1. The company's credit rating was downgraded to junk status, triggering clauses that required them to repay their massive debts immediately. But the money wasn't there. It never was. On December 2, 2001, Enron filed for Chapter 11 bankruptcy, the largest in U.S. history at the time. The fallout was catastrophic. Thousands of employees lost their jobs overnight. Worse, many had their entire life savings wiped out. The company had heavily encouraged employees to invest their retirement funds in Enron stock, telling them it was a sure thing, even as executives were secretly selling off their own shares. They lost their jobs and their pensions in one devastating blow. Investors worldwide lost billions. The accounting firm Arthur Andersen, one of the largest in the world, was found guilty of obstruction of justice for shredding documents related to its Enron audits and was effectively destroyed, putting tens of thousands more people out of work. The Enron scandal sent shockwaves through the entire business world. It exposed a dark side of corporate culture driven by greed and a winner-talkists mentality. In the aftermath, top executives faced justice. Andrew Fasto pleaded guilty and testified against his former bosses. Jeffrey Skilling and Kenneth Lay were convicted of fraud and conspiracy. Lay died before he could be sentenced, but Skilling served over a decade in prison. In response to this massive breach of trust, the U.S. government passed the Sarbanes-Oxley Act in 2002. This landmark legislation introduced sweeping reforms to corporate governance and accounting practices, holding executives personally accountable for the accuracy of their financial statements and creating stricter oversight for auditors. The story of Enron serves as a powerful and timeless warning. It shows how easily deception can be dressed up as innovation, and how quickly a celebrated success can be revealed as a hollow fraud. It's a reminder to always be skeptical, to ask the tough questions, and to remember that if something seems too good to be true, it probably is. The name Enron will forever be synonymous with corporate corruption on an epic scale. Thanks for watching, and if you found this story fascinating, be sure to subscribe for more deep dives into history's biggest events.